So if we quickly look over to where the market is on BTC USD, you can tell this is a short position. And let's take a look structurally where we're at. As you recall from Monday markets or whatever else, lowest close support, highest close resistance, and we're currently trading at the range midpoint. And the reason I've taken a short-term trade here, I'm aware it's the range midpoint, but the context is that this leg here broke market structure. It made a lower low and the lower low close. So any rallies into resistance are ones that I can technically sell. Even if not for a swing strategy, like this leg here from range midpoint to range low is not something I'd be terribly keen on, because I don't like putting on swing positions in the middle of the range. Purely from a low time frame perspective, I have a fresh test of resistance after a break in market structure that's also taking place above previous day's high. So there's enough kind of confluence factors there to allow me to at least smack the level on a very low time frame. The way this strategy works is I'll trade high time frame levels, but I'll trade them for low time frame targets. So even if I'm slightly correct, and even if it just does simply consolidates, maybe pulls back a little and then goes to the range high, I can still make money on those trades. So the core premise of my short-term trading strategy is that I will trade high time frame levels to low time frame targets. So smaller moves from high time frame levels. The setup here specifically, if we go over to where the risk to reward tool is, this is something I discussed in my entry triggers video, so go watch that. The basic idea was I was looking for signs of resistance around this 0.05 level, the range midpoint. For me, that was first of all the spike, which is always a good sign to see, some signs of absorption, failed breakout, whatever, just some wicks or bearish price action. And then the second thing was a 5-minute close below the level as well, which was this candle here, and that's essentially where my entry was. There are probably more delicate entries. Again, from the entry triggers video, you'll know that whenever you get this type of price action, where the market has a level, exceeds it, and then falls back below, you can always look at the pre-breakout consolidation or the trader main breaker or whatever you want to call it, and use that as your entry trigger. So you'd box this out and then you'd be comfortable selling anywhere within the gray box. I didn't do that. My entry is worse than that, but I'm fine with it. And again, in terms of targets, the basic premise, as I've said probably about 3 times now because I repeat myself and I'm an idiot, is that I'm trading high time frame levels but to low time frame targets. So I'm not trading it to the higher time frame target, which for example would be the range low. No need for that at all. It's a day trading, scalp, whatever strategy. So I simply jump down to the 4-hour, 1 hour, sometimes the 15-minute, and see where the next level is, kind of immediate resistance. And for me, I've elected to choose this 1 hour last high pre-breakout, and you can kind of eye test see that it's within a level of resistance, right? Just this entire shelf, this entire consolidation. And if we go down even on lower time frames on the 15-minute, resistance, like, there's something there, and that's where I want to get out. In terms of the risk reward for the trade, it's 1 hour. And that might sound, unreasonable to some people listening, thinking, oh, well, I read that you need to trade a minimum of 2 to 1 or 3 to 1 or whatever it is. That can't be true in isolation. If the probability of a setup working out is high enough, your risk to reward threshold for it should be lower, because that sort of skews the other side of the expectancy. You either want lower hit rate setups but with a higher risk to reward that will generally compensate for the low strike rate, or higher strike rate, and it's fine if those setups have a lower risk to reward because you can size them more, right? To reflect the higher probability. Like risk reward without probability doesn't make sense. For me, this is low risk reward and generally higher probability, which is kind of what I like. And again, what I like about this strategy is there isn't a ton of active management to do. I'm basically right on these trades if my high time frame levels do something. As long as they produce some sort of reaction, I'm not asking a lot from the level. As I said, I'm not saying, it has to go all the way from daily resistance to daily support or anything crazy like that. As long as it prints some sort of visible reaction, even if it ultimately ends up reversing and going higher, for me, that trade is done. So it's a very low bar to set for the market. Your daily resistance, and I'm asking you to take me to 5 to 15-minute support. If you can't even do that, then my read on this being daily resistance is completely wrong. First of all, it did hit the target. So, it came down through this level and that's it, filled out my limit order. But I think there are some important lessons in the price action that followed. First things first, if we look at how price initially developed, you can see that after I entered on this 5-minute close, immediately the market moved in my favor. Now, this is actually very dangerous because for a lot of people, that's when they see profit on their screen and their desire to manage the trade or what they think is protecting the trade is very strong. So what you'll often see is people enter a trade and as soon as it moves in their favor, they will move to break even in order to make it quote unquote risk-free or lock it in or whatever type of term you may use. Now, on this occasion, had I done that, and moved to break even, almost, the next candle would have taken me out. And I certainly would have been squeezed by this, but in any case, there's no way I'm reaching my take profit if I manage the trade that aggressively. So when I move to break even, or if I do move to break even, which is quite rare, it's not based on the P&L or trying to lock something in or risk-free trade, this, that, and the other. I have to assess the integrity of the original trade idea. So I'm not just looking at am I in the red or am I in the green? I'm looking at what does the price action mean for the reason I entered the trade in the first place? Is it supportive of my idea, or does it seem to be shifting the probability and refuting my initial idea? So if we assess where this kind of drawdown took place, and again, it's not a trivial amount. If this is my entry and this is the highest point made, this is like half an hour or something. You're certainly feeling that in your P&L, right? It doesn't feel good. However, if we sort of return to the original premise that this daily midpoint and the cluster around it is going to act as resistance, does the price action support that view or refute that view? Well, let's look at what happened. The highest push, the point of maximum adverse excursion, or the biggest drawdown I faced, was this bit of price action here. And what happened? The market rallied into the same daily level which I originally argued was going to be resistance, the entire foundation for the trade idea, and then it sold off from there. So that's fine. If we take the second highest point of drawdown, which would be this rally, does that in any way mitigate or refute the initial trade idea that this is resistance? Well, no, because the market rallied into it, found resistance, and moved lower. So you can see that if your management is purely P&L based or arbitrarily break-even based, a lot of the time you can just take yourself out of positions that would otherwise be profitable or good trades because you're just being too jumpy in managing them. The other point I will make is, you'll recall in the original, in the first half of the video, my premise was that for the most part, when I'm executing this low time frame strategy, once I have a trigger, I'm either right or I'm either wrong. Now, that's a very type of passive style of management, and again, that's for two reasons. The first is, as I mentioned, I'm not asking a lot from this level. I'm not saying you're the daily range midpoint, take it all the way to the daily range low, and there's a lot of gap space to cover here, which may require management. It's a bigger swing. On this occasion, the bar for this level to do its job is minimal. You're a daily level. If you're remotely going to act as resistance, there should be no issue taking the market to hourly support. That's not a big move. So even if the level performs the bare minimum required of it for the trade to work out, which is to provide some sort of reaction, then my take profit should be hit. And if it's not, then that in itself is evidence that my idea is wrong. So that's the first reason that my management is hands off. It's because the bar is so low. The second reason is one that I've kind of learned through a lot of journaling and sort of, I guess, painstaking reflection, is that I used to be that guy where as soon as I'd get my entry, I'd be stuck on my execution time frame, microanalyzing all of this price action, looking for reasons to get in, get out, or manage the trade. And you can see all sorts of demons in the chart if you subject yourself to that type of approach. For example, I could have quite reasonably said, well, look at this price action here. It came down, spiked the lows, closed above. That's an SFP. That's bullish. So now I'm seeing bullish price action before my target was hit. Maybe I should just close here and lock it in. And you can come to all sorts of arguments like, oh, look, this move here, or, let's take this leg. This leg is a break in market structure and looks like it's finding support there. And look, a big hourly engulfing candle, whatever. So there are a million ways that you can sort of, as the Russian expression goes, see a black cat in a dark room and convince yourself that the price action you're seeing on very low time frames is somehow conferring an edge or instrumental in trade management. And in my experience, considering the low bar for this idea in general, it's worth just leaving it. Now, that may vary, and I think the higher the time frame that you execute on, the bigger the rotation, the bigger the swing, the more active management it may require. But on this occasion, the bar for the trade is so low that there's a very high likelihood that all I'm seeing here is noise, not signal. I'm either right that this is going to do something, in which case there's a high likelihood that I see my target, or I'm wrong and I'm fine with eating my stop, or maybe being able to get out if there's clear evidence that the market doesn't agree with me before my hard stop is hit. But what I think is generally a bad habit, especially for like very short time frame trading or when you're doing business between two very clear levels, is assuming that every single bit of price action that follows after your entry is instrumental to the trade idea itself. You're not that important, especially if the time frame is particularly low. There's just a lot of candlesticks there, man, and you'll start to see shit. So I've discovered through, again, first the reasoning that this is a big level, this is a small level. If I'm somewhat correct about the big level, it should have no issue hitting the small level. That is the first kind of pillar of this strategy. And the second one is that on average, overall, after enough trades, the management signals that I get in between the two levels that matter, so anything that takes place here, doesn't tend to be that formative or that important.